Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now let's flip over and look at the other side. Well, no, actually, let me answer one more thing first. What about the max loss? If the max loss is 6, that's good to know, but at what point do I lose that full $6? Well, it's pretty straightforward. Again, look at the P&L chart down below. The long strike price, you can see, intersects the red zone right where it goes horizontal, so that means anything below the long strike price, in this case 40, is where I hit my maximum loss. So if I'm below 40 on Jan expiration, I lose $6. If I'm above 50, I make $4. If I'm anything between 40 and 50, I might make a profit, which would be in the green triangle. I might lose money, which would be in the red triangle. It's going to depend. Really, what it depends on is whether I'm on the upside or the downside of that break-even line. That 46 is the point down below where the green turns to red. If I'm above 46, I make a profit, but it'll be smaller than a 4-point profit. And if I'm below 46, I make a profit, but it'll be smaller. I make a loss, but it'll be smaller than the 6-point loss. Okay? Now let's look on the other side, a credit call spread. This is when I'm bearish. Same sort of thing here. Okay? I'm going to sell a January $50 call on the EUI, which is the dollar versus the euro, and at the same time I'm going to buy a January $60 call at 1. This trade is also done at a net credit of 4, but the difference is I'm bearish this time. And you can see that by looking at the credit call spread P&L chart below. I want the index to go down. I want the dollar to lose ground relative to the euro. How do I calculate my break even? The main position, in this case, the main position is not the long leg, it's the short leg. It's the expensive leg. Always think about the main as being the one that costs the most or is worth the most, not whether it's long or short. Because it doesn't matter whether it's a put or a call, it's whether it's the most expensive leg. In this case, the most expensive leg happens to be a short call leg. Well, a short call leg is a bearish strategy. You want the underlying to go lower when you sell a naked call. So that means my sentiment is bearish. The fact that I bought the 60 call to hedge the upside doesn't change the fact that I'm bearish on this trade. So my break even is calculated on a credit call spread as my main position plus the credit. So in this case, the main position strike price is 50. I add the credit of 4, that sets my break even at 54. So on a put spread, it's the main position minus the credit, and on a call spread, it's the main position plus the credit. Maximum gain here, again, just like the other one, it's the credit received of 4 points. This is a 10-point spread, so my max loss is 6. Same thing as before. Where do I make my max gain? Well, my max gain occurs below the short strike price, in this case, $50 call. Because once again, I want both the options to expire completely worthless so I can keep the entire credit. And that's only going to happen if the index is below 50 at expiration. Because if the index is below 50, nobody's going to exercise a long call and pay 50 for that index when they could buy it cheaper at the market. And nobody's going to exercise a $60 call either when it's below 60. So those are going to both expire worthless. On the other hand, if the dollar rallies sharply against the euro and it's way above 60, both those options get exercised. You're going to exercise your call option at 60 to buy the index at 60, and then you're going to be assigned on the 50 leg and you have to turn around and sell it at 50. That's a 10-point loss. But because you got 4 points credit at the beginning, you end up with a net loss of only 6, and that's where you calculate your net loss of 6. I think you got it. Let's move on to the next slide. Now, let's do a comparison here on the credit put spread. Remember what I said at the beginning. The reason that I do credit put spreads, the only reason I do credit put spreads, is because I want to be bullish and I want to bring in a credit, but I don't like big risk. And the truth is, when I sell naked puts, I take on big risk. Big risk if I'm wrong. If I'm right, there's no big risk. Things work out great. Problem is, I'm not right all the time. And I think most of you, if you've traded for any length of time, you know it's not possible to be right on every trade. You know, even a great baseball player is only right 3 times out of 10. When you trade, hopefully you're probably better than that, but you're still probably only right maybe 60, and if you're really good, 70, 75% of the time. That still leaves you pretty exposed for the few times that you're wrong. And The bad thing about being wrong is sometimes you lose a lot more on the wrong side than you make on the upside. So you might have one bad trade that wipes out several good ones. But if you use spreads, that doesn't happen. That's why you want to use the spreads. Look at the comparison of the two charts. If I sell 10 naked $70 puts on the euro at a price of 2, I'm going to bring in $2,000. 2 points times 100 times 10 contracts is $2,000. But notice the big red zone on this chart. My loss is limited, or my loss is significant in that I can lose if it goes all the way to 0. Now, you and I both know the dollar's not going to go to 0 relative to the euro unless the dollar disappears. If that happens, we got much bigger problems. But in theory, in textbook concept, the risk is substantial. Okay, it's not going to 0, I agree, but it could go pretty low. But then look on the right. You'll notice that the chart looks similar because basically my short leg on my spread is exactly the same as my naked trade on the left. Only in this case, I'm going to put on a hedge to the downside in case I'm wrong, in case the dollar doesn't rally. This is a credit put spread, so I'm bullish. But what if the dollar loses ground against the euro when I think it's going to rally? To protect myself in case I'm gone, I'm going to go out there and buy some really cheap, further out of the money put options for 50 cents. In this case, the $65 puts. You know, the dollar's at 72 versus the euro, and I'm concerned that it might, that it might drop way down below 65. It's not likely, but it could happen. And in case it does, I want to be sure that I'm protected. Now, is it going to happen in a month? No. But if I was putting this trade on, say, for January of 2010, that's 6 months out. Who knows what could happen between now and then, right? So the point here is this trade is done at a net credit of only $1,500 rather than $2,000 because I have to spend. I bring in $2,000 when I sell the $70 puts, but I got to spend $500 to buy that hedge to the downside. But notice the difference. Look on the chart. Buying that hedge limits my risk to a maximum of only $3,500. So even if I'm horribly wrong as I can be, I'm only going to lose $3,500. I could do a whole lot worse than that on the naked put. This is why I do credit put spreads. I do them on currencies. I do them on equities. I do them on ETFs. I might do them on any other kind of index. The main reason I do them is because I'm concerned that if things go wrong, it's going to go way against me, and I'm going to lose a bunch. So that's why you really ought to consider using credit spreads as opposed to naked. A lot of people trade naked options, and naked options are one of those things where you're going to be right 80% of the time, but then that 20% that you're wrong is going to wipe out all your profits that you made on the other 80%, and that's something you don't want to have happen. If you do it as a credit spread, you will end up with a little bit smaller profit on every trade, but on the ones that you're wrong on, you won't get killed, you won't get wiped out, and you won't lose a ton. All right, let's take a look at this comparison of the credit call spread, which is the bearish strategy, to the naked. Now, in this case, this is the dollar versus the British pound. Let's say I believe that the dollar is going to lose ground relative to the British pound. I could go out there and sell the $75 calls, 10 of them at a price of 2. I'd bring in $2,000 in that case. And if I do that, notice to the right, the risk here is essentially unlimited. If the dollar rallies against the pound and continues to rally, then the risk continues to rise. Now, I can't show all of that because it's an infinite number, but to the right, the risk continues to go higher. Whereas if I take that same short leg, the $75 calls, and I put on a hedge by buying way out of the money calls at a strike price of 80 for about 50 cents, I'm only going to bring in $1,500 in this case instead of $2,000, but my risk, as you can see, is capped off at $3,500. So what do I give up? I give up $500, but I get rid of a substantial amount of risk. So again, if you're one of those people that likes to trade naked options, I typically always discourage people from trading naked options of any kind. It's so much easier to put on a credit spread and reduce your risk substantially, and you really don't have to spend a whole lot. You're not going to be wrong very often, but it only takes a couple of times of being wrong when you're trading nakeds to get really wiped out. And it's frustrating. I've had it happen to me a couple of times, and then I learned my lesson and stopped doing it. But I had a bad trade in February. I wasn't back to even until August. Who wants that? That's not worth it. It's much better to take a little bit smaller profits and do it more often. And then when you're wrong, you can make it back up in just a couple of trades.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.